Well, Ignacio, if you don't mind giving us a little bit of background. So some of these people have been, some traders have been with Darwin for months. Nobody's been for like 8 months or 6 months, but I think the earliest is like maybe October of last year to just barely getting started to still on the fence about Darwin. So
Okay.
that's kind of the audience that you're presenting to. Now, I've talked to them a bunch about the positives about Darwin, but where I fall short is some of those questions that I fired at you that I just don't know on the back end stuff. So I'm sure there's a lot of that that's want to go on. But if you don't mind just giving like your 10,000 foot view and pitch of who you
By
are
all
and
means.
why Darwin makes sense, right?
Okay, by all means. So to give you a bit of background, we set up Darwinex more than 12 years ago when my brother, who is happened to be a trader, like he used to work as a civil engineer and he was a trader himself. As like this was his main hobby, and he enjoyed trading so much that he wanted to make a living out of it. And when he started, he came up with a consistent trading strategy. And when he thought, okay, now I want to raise third-party capital, that's when he realized he needed to be regulated, and regulation was a pain. So he thought there must be other traders out there who are good at trading, but just don't have either the money or the contacts to become regulated and make a living properly from their home. So that's why we came up with the idea of Darwinex. Initially, the business model of Darwinex was we set up an asset manager company with a view to investing in those traders. So we were looking for good traders out there with a view to allocating capital to them. And the initial business model, in order to get that done, since traders need a broker to trade, we launched our own broker. So we initially were regulated as both as a broker and an asset manager, and that's how we've been operating for until 2023. And then in 2023, with all these prop firms coming up, we realized, okay, hold on. There are a lot of traders out there who are now trading without actually using a broker because they are using prop firms to create their trading signals. Now we know that the business model of those prop firms is flawed because at the end of the day, there's a conflict of interest in the sense that since traders are not trading real money, prop firms are not making any real profit out of those trades. So they live actually out of the losses of those customers that are failing the challenges, and they use that money from those subscriptions or challenges to pay the successful traders, which happen to be a little amount out of the whole amount of traders. So that's when we realized, okay, prop firms are flawed, but they helped us in the sense that we could follow their structure in the sense, or their strategy in the sense that we could access trading strategies without actually having to force traders to open an account with our broker. So that's why we launched Darwin Zero last year, which is essentially the same. There's still a regulated asset manager behind the company, but instead of having to prove your worth as a trader through a live account with your own money, you can open a virtual account with Darwin Zero and prove your worth as a trader on Darwin Zero without having to actually risk your real money. You just pay the monthly subscription, which happens to be 38 euros, which is roughly 42, 43 US dollars. And if you do well, we will initially allocate virtual funds. And in that sense, that's similar to prop firms in the sense that if you do well through Darwinia, you will be getting allocations to prove your worth, and you will be paid out of those allocations. And those allocations are virtual. But those that do well will be then open to third-party capital, where we have currently, through our asset management license, we have more than 100 million in the management. And that's what makes us different from prop firms in the sense that there is no conflict of interest in our case. In our case, if traders trade well, we are the first ones interested in them succeeding because we will be monetizing their strategies through investor capital that we will be raising ourselves, or eventually we're also investing our own capital into these traders. So I hope that makes sense. It's basically Darwin Zero is similar to prop firms in the sense that you can make money without risking your money, but it's different from prop firms in the sense that there are no rules whatsoever in terms of return, drawdown, time limits, and so on. And it's also different in the sense that there is no upside. So our best trader at the moment is managing more than 30 million from third-party capital, whereas in the case of prop firms, I take it you cannot manage more than X amount of money. And if you do very well, at some point you will get banned because it goes against their interest. Not sure if that makes sense.
Yep.
Thank you. Thank you so much, John.
Yes. Yes, yes.
So
Okay, so
that's one of the things I really love about Darwin, and it's something that I've told my group over and over, that it's something I was trying to build to that end, but I was like, well, Darwin's already done it, so why not just piggyback off of what they've done and run with it, right? Now there are some, I think most people here have a question of how to trade Darwin, right? I mean, there's, like you said, your best guy is trading 30 million in capital. Well, we would love to hear more about not necessarily him, but how are your best traders trading? Are they trading currencies? How are they holding positions? Are they trading commodities? Like, what is the sweet spot with Darwin that we can really, because we're a savvy group of traders. I don't think most of the traders here have years of experience trading. And so we can really dive into the nuts and bolts of what you would suggest of being a successful trader with Darwin. What does that look like? Do you know what I mean?
okay. Yes, I do. Yes, absolutely. So the beautiful thing about our model is that there is no one single trading style that you need to follow. So in fact, that trader that is managing more than 30 million, in fact, almost 33 million with us, he's a news trader. And that's something I would never recommend, because we always say, if you want to be a consistent trader, you need to stay out of the news and so on. So in essence, going back to your question, how shall I trade with you guys? All you have to do is trade your best in a way that you feel, the way you feel more comfortable with. Okay, so there are no restrictions whatsoever. So if you feel comfortable trading 1 hour timeframes and being or 30 minutes timeframes and you're a scalper, that's fine. Also, if you are a swing trader and prefer to follow the trend and keep trades open for 3 weeks, that's absolutely fine as well. So at the end of the day, remember, we are an asset manager looking for good traders. So the only thing I would encourage you to do is to trade in a way such that you will not regret any of the trades that you're placing. So place the trades in a way such that 2 months from that trade or 4 months from that trade, when you look back at that trade, you do not regret having placed that trade. So the whole idea behind our business model is that you traders build a consistent track record, which would be similar to your CV, that we will then be presenting to investors. So it's all, the only thing I would recommend is to approach our service with a long-term mindset. And long-term does not necessarily mean that you have to be a swing trader. What I mean is you need to approach this in a way such that you need to know that you're building a track record that you would be presenting to investors in 3 months time, 6 months time, 1 year time, or 5 years time. So this specific trader that I mentioned, who's managing 33 million, he's got a 9-year track record with us. So it's all about consistency, and it's all about you managing your risk. Either you can do that either with FX, stocks, futures, whatever you feel more comfortable with, that's absolutely fine. We're just looking for consistent traders with a long-term mindset.
So I love that you said that it doesn't really matter what you trade. It's it's more in how you trade it, right?
Exactly.
And so we've had a lot of conversations about this, and it's like it all comes back down to your risk. In my mind, and correct me if I'm wrong, but this is how I'm viewing Darwin, is it doesn't really matter what percentage that you make. It matters what your risk score is with Darwin. And that's more important for the trader to manage their risk score versus swinging for the fences and losing win. Does that make sense? And
It does make,
you say
yes,
consistency and that, but is it consistency in how you trade, or is it consistency in just getting profit every day, right? And so that's kind of the thought we're having, right?
yes. So this is the one thing that I did not mention. So the way we work is, because we're a regulated asset manager, whenever we offer any given trading strategy to investors on our platform, we need to do that in a way such that we keep the risk under control. So the way our platform works is traders trade at whatever risk level they like, and then we will be copying their trades on behalf of investors at the same risk level for all the strategies, which means our platform is a level playing field where all the traders are trading with the same risk level. So basically, you trade at whatever risk level you like, but then you need to be aware of the fact that we will be copying your trades at a risk level that we manage, so that you are not in an advantage or disadvantage in terms of risk compared to other traders. So all the traders will be copied at the same risk level, and that means that all the traders that you see on our platform are comparable on an apples to apples basis, because all of them are being replicated at the same risk level, if that makes sense. So going back to your question, David, we're not really assessing, or you will not be penalized, or you will not measuring your consistency in terms of risk, because, as I said, the risk is the most relevant factor for us, but we will be taking care of it. So no matter if you are reckless when managing your risk, but your strategy is consistent in the sense that it is profitable, that's fine, because we will be copying your trades at a lower risk level and they will still be profitable. Okay, so when I mean consistent, I mean, and it doesn't have to be beating the markets on a daily basis. It just means keep your trading under control, so that you don't have a large drawdown at some point, because that might scare investors away. All you have to do is, I was talking yesterday on a different webinar, and the whole idea is, as they say, fake it until you make it. So we're playing here that you're managing a hedge fund, and we will be rewarding those traders that get the most consistent numbers in terms of risk-adjusted return. So trade as if you were managing a hedge fund, or if you're aspiring to manage a hedge fund. And then if you do well enough, we will be helping you in that process and allocating capital to your strategy.
And I love how you said that, because one of the things that we haven't, so we've been trading as a group together full time. So we trade, just to give you a little background of our group, we trade about 2 hours every single morning together. And we've been doing that consistently for just about a year. So we're not like a long group, but I've been trading with these guys off and on, some of these guys for 5 years, right? But it's about a year ago, we're like, you know what, we really 2 hours a day, let's go, right? And so we're not novice traders, and so we're with that. One of the things that I love about Darwin is we're not talking about strategies anymore. We're talking about being a risk manager, how to manage your risk. You're not trading for profit for today. You're trading for the week or the month, the year, right? And so I think this group is fully on board and understand that we need to build a track record with Darwin. The biggest conversations that's coming from the group is like, well, what if we screw it up? Right? What if we screw it up in the first 30 days? Or what if we take a trade that we don't normally take? Or what if we do things that we don't normally do? Should we just start over, or should we keep going, right?
Okay. Yeah. So I was reading Brandon's message on the chat. He says, so would the ideal combination be to trade smaller position size, meaning minimal drawdown, even if profit is not significant, getting multiplied by the risk management system? That does actually make sense. And going back to your question, David, if you don't start off well, that's absolutely fine. All you have to do is keep going. So the way I see it, I do compete in triathlons myself, and I do long distance triathlons. And to me, trading is similar to running a marathon. Just think of it as you're building a track record. And I get this question asked a lot. Okay, what happens if I don't do well my first month? If a marathon is in miles, I think it's 26 miles, right? So if a marathon is 26 miles and you fall down on your first 100 meters, what shall I do? Shall I leave the race? Well, not really. You just stand up and keep going. And this is a 3-hour race, 4-hour race, 4-hour race, a 5-hour race. And if you just fell in your first 15 minutes, that's absolutely fine. There's plenty of way ahead to prove your worth and to recover. So I know there is this urge to restart, but at some point you will always have a drawdown. And what needs to happen is that you keep that drawdown under control, and that you're able to prove to your investors further down the line in the future that you were able to recover from the drawdown. So going back to your question, David, what happens if I don't start off well? Well, just do your best to recover from the drawdown, because there are still 26 miles ahead for you to run, and there's plenty of way for you to prove that this was only a small mistake within a long track record.
And the way I understand it as well, Ignacio, is that even if you have a bad, let's just say March was really bad for everybody, right?
Mm-hmm.
Well, in April 1st comes along. Let's say that he had a 10% drawdown in March.
Mm-hmm.
April comes along, and you're up 5%, or you can still receive allocation from Darwin if your April was good, because you don't really care about March in silver. Is that correct? Is that my understanding?
Well, so for allocation purposes, we take into account your current month return and the previous 5-month returns, and
Okay.
your worst drawdown in the past 6 months. So drawdown matters, of course. And going back to the marathon, if you fall down and you can stand up, that's fine. If you break your leg, maybe you need to quit that race, of course. So if you have a 50% drawdown, 40% drawdown, I don't know, maybe you need to reconsider whether that strategy is going to bring you to the top at some point.
Okay.
So yes, we do account for past returns, although the current month return have more impact on the rating that we use to calculate or to decide allocations. So the one thing that you need to realize, though, is that, as Martin was saying before, so basically Darwinex offers a risk-adjusted portfolio of strategies to the investors. Mm-hmm. So what we do, and in line with that, what we do is we have a risk engine that works at arm's length from the traders that adjust the trades on behalf of investors. So what could happen is that even though you get started with us and your drawdown is awful on your trading account, that does not necessarily mean that drawdown will reflect on investors' accounts, because there is our risk engine which will be copying your trades at a different risk level. So if you had a large drawdown, the chances that you were running at a very high risk are high. Mm-hmm. So although it might sound complex at the beginning, mm-hmm, a large drawdown in your trading account does not necessarily mean that your Darwin or your trading or your index, mm-hmm, as we call it on our platform, will inherit that drawdown. So my recommendation would be, there is what they call the so-called calibration phase, which takes 2 to 3 weeks, trading weeks, which is basically a period in which our risk engine accommodates to your trading style. What I would recommend you guys is to just focus on your trading account, forget about our website, forget about everything, just do your best on your trading account. And then once you have completed the calibration stage and so on, we can have a look at your standings and your statistics and see how you're doing in terms of Darwin. So my point is, this is a long distance race. Don't look at, like, as I was saying, after 1 month, although for prop firm standards, maybe 1 month is a lot, but for real professional trading standards, 1 month is just getting started. So my suggestion would be, I'm reading boss's comment, exercise running, I'm out. Sorry for that. Yeah, so, but no, my point is, forget about the risk statistics, forget about everything. Just every day, sit down in front of your laptop and try to do your best with your trading account and forget about everything. And then after 1 month, we can sit down and say, okay, now that I have something to start with, let's have a look at it and let's see how we're doing. Okay, and then, so referee Pete is asking, what would you say is the most important metric with Darwin? So the most important metric at the end of the day is your return and your drawdown. Keeping them under control. And when I speak about return, our best trader has made, and this is our very best trader, he's managing more than 30 million. He's been making like 20% a year for the last few years. That is fantastic, and we don't expect everyone to be doing that. So exactly as Martin is saying, the return to drawdown ratio is what we would consider at the end of the day to be essential. And as I was saying, that does not mean that we're expecting you to make 5% a month. That's not what we're looking for. We're looking for consistent traders. It's fine if you have negative months, but just make sure if you have a negative month, don't let it be like a minus 20% month, because that would not look nice on your CV. So try to keep your moderate returns under control, and try to keep your moderate your drawdowns under control. Of course, if you can have fantastic returns with a very low drawdown, that would be amazing. But all in all, we know this is a tough game, and it's not something that, I mean, drawdowns will happen because this is part of the game. And all we would ask you is to not be carried away by those drawdowns, and make sure that, as David was saying before, even if you have a bad March, well, then April is a new opportunity to recover from those losses, and don't let the drawdowns kill you, so to say.
So one of the things that you showed me in our very first call that I'm trying to go back to memory, so correct me if I'm wrong, but it was my understanding that you showed me an actual track record of a trader that didn't get allocation for like 6 months, didn't
Yep.
receive any allocation, didn't receive any allocation, didn't receive any allocation. And then they, like, all of a sudden they had the aha moment and went from 0 to like just skyrocketed. I don't remember the number, but after a few months, they were trading like a close to $1 million in trading capital. Is that an uncommon or common scenario where traders go, and then all of a sudden, boom, they take off? Does that make sense? Because now you have their track record. You know what I mean? Where we've traded with you guys for 6 months, 8 months. Is that more important than maybe hitting the silver allocation steps along the way? Does that make sense as a question?
It does make sense, yes. I mean, it's not easy to skyrocket from that one day to the other, but
Sure.
There was a case a few months ago where the winner of our competition, or a monthly competition, they started with a very negative returns back in, I think, October last year or so, or even, I don't know, maybe June last year. And then it took them like 6 months to recover from the drawdown, but they were trading consistently for those 6 months, recovering from the drawdown. And at some point, they were able to prove that that drawdown was an accident, and now they have managed to recover from that loss after several months, and they got I think a 375K allocation, and they keep going with that. So it's a matter of building a track record. We will be incentivizing traders to trade properly during that period as they build a track record, and then hopefully after 1 year time, they look back and say, oh, hold on, I've been doing my best month after month, and now when I look back, I have a 12-month track record that I can present to third-party investors that could be eventually interested in allocating capital to my strategy.
Yeah. On that note, building a track record, you said there was a guy who's been doing it for 7 years, and he has 33 million in allocation. Is that right? What is his ticker?
Yes. That would be THA. So there's please note that there's, as I was saying before, 2 services, Darwinex and Darwinex Zero. Darwinex Zero was launched last year, whereas Darwinex is the one that has been around for more than 10 years now. We launched it back in 2012. So in the case of THA in Darwinex, that's a trader who's managing a live account. And for several years, they were getting humble amounts of assets under management. And then, like, let me check, I'm looking at it as we speak. So they started getting traction from investor capital back in, sorry, I'm just looking at it. It's loading. So until May 2022, they had somewhere around 3 to 4 million. And that amount has been more or less stable since 2018, they had 2 million. And in 2022, they still have, well, they started growing to 5 million. Then it went up to 37 million. And now they've been going through a stagnation phase, and they're currently at 33 million. So the ticker is THA, as in Tesla, Halloween, Alpha.
Yeah, and I've heard of it because people mentioned it.
And they're doing quite well. But it's taken them a couple of years, and that's why we created Darwin Zero and Darwinia, so that, because we know it takes time to prove your worth and to feel confident when approaching the market. So we're giving this more incentives through Darwinia, so people don't lose their control while building that long-term track record. And yeah, that's our case.
Yeah. What kind of style did you say that THA is using?
THA
Like
is
scalper, swing?
they are a news trader, which is, as usually we always say, don't trade the news, but they trade like the high impact news. And but they have like a very that's a team of traders who have a very I don't know, focused approach where they analyze all the possible outcomes of the speeches by the governors and so on, and then based on that they decide how to act depending on what they say on these speeches or in these news releases.
Yeah.
But that's something I personally would not recommend because, as you may know, volatility during news releases is very high and it's very hard to keep your risk under control. So they are a very special case.
Did you say it was a team of people that's working on it?
That is correct, yes.
Who's that?
It's a team. There are companies called Finbo. It's a Swiss asset management company. And yeah, it's Atu, who is the trader behind it. The head of traders behind it is a Finnish trader, and he hired a couple of traders to join him to analyze.
THA has a team that works with him.
Yeah,
exactly.
To do the news stuff.
Because you need a team to do all that analysis. That's a lot of analysis.
It is.
Yes.
It is.
Yeah. So, Ignacio, I think, so just to give you an idea of what I'm planning and, to help you to help us, is that I'm planning on making the Darwin trading a focal point for Trade the Fund in our group, and we're going to trade that every day. What I think I'm looking for personally is the roadmap to success. And I know that you said it doesn't matter what you trade, how you trade, when you trade, what you trade, as long as you're successful. But in doing a little bit of your deep dive, and I don't know how old the information is, I came to find out that for scalpers, which is what we kind of do for the 2 hours in the morning, is we kind of scalp. Our goal is to hit 0.25%. Most days we do that and we're done. But if some of your doing a deep dive on your stuff says that if you are a scalper, at one point I read on some of your education that if you hold trades less than 15 minutes, then your leverage is reduced to 16.25 instead of the 30. I'm not sure if you're familiar with that or whatever, but it's in some of your
yes,
stuff.
I think you're referring right? to the risk adjustment that we make, but it's
right,
it's
your
not
deleverage is what you call it, is your deleverage. And so I'm like, so because we do that, would it be better for us to trade as if we only had a 16 leverage versus a 30, because that's kind of more
no worries. We will never amend the leverage at your trading accounts level. So you can trade at whatever leverage you feel comfortable with. So as I said, my suggestion would be forget the Darwin, forget the risk engine, forget everything, and trade your own style. Trade in a way that you feel comfortable with. Trade in a way that you think you will be able to trade for months. And then after you have a sample enough of data, we can sit down and say, okay, now let's have a look at how this stands on your website and so on. I was reading Robin's question about the risk engine to recalibrate, or the risk factor. So just so you know, we take into account the last 45 trading days. So if you have, Robin was asking, if you trade consistently, but one day you put more than trades than usual, the risk engine sees that and cut your risk ratio. Well, it will take that dent into account, but it will accommodate to that. And if that happens one day within the last 45 trading days, it will know, okay, this was, so to say, just an accident. It will be careful going forward, because it will know, okay, careful, because this trader every so often has a large risk increase. But other than that, as I said, I mean, trading is hard enough, and beating the markets is very hard. So adding more complexities to that is the least we want to do. It's the last thing we want to do. So this being the case, to get started with, I would forget about all our statistics. Just trade your own style, and then once you feel confident with what you're doing, we can sit down and say, okay, how does this stand in your platform and so on. But if you're scalpers, David, that's absolutely fine. We would not be adjusting your trading account leverage or anything like that. This refers to the risk at which the risk engine will be copying your Darwin and so on.
Yeah.
But as I said, there's no point in you changing something if you don't know yet how the risk engine will react to that. So my point would be trade your own style, and then once we have some information and some data, we can sit down and see how you're doing. And going to Joshua's
So
question.
I keep
Sorry, go ahead.
hearing that, but sorry, I'm sorry, Ignacio. I keep hearing you say trade your own style, trade your own style. But isn't there, like, over all of your traders, isn't there one style that might be more lucrative or more in line with the Darwin risk engine? And I only ask that because we're open to finding what that sweet spot is and adjusting and pivoting. Like, we're not just trying to just trade one style or one strategy or whatever. Like, what is the sweet spot? Tell us what that sweet spot is and we'll trade it. Do you know what I mean? And because we understand, I think our group understands how to trade news, how to scalp, how to swing, how to do any of that. We're just trying to be like, what is going to give us the best advantage here? Does that make sense? And if that,
it does make sense, but I'm afraid
that doesn't matter.
I mean, our best trade. It's not our trader with more assets under management is a news trader. The second who trades currencies. Our second trader with more capital under management is a swing trader trading indices, keeping trades open for several weeks. I mean, there's going back to the marathon. So what shall I do to win? Well, shall I take, I don't know, do whatever you feel comfortable with. And then as long as you're able to beat the markets, keeping your risk under control, that's fantastic.
You're saying any style can work, I guess, as long as you do it well and efficiently.
Exactly.
So did you say, is there some kind of penalty for trades less than 15 minutes?
There is not.
No, okay.
No. Just gotcha. You need to bear in mind, though, that the more sensitive your strategy is to execution, in other words, if you're scalping for shorter time periods, that's absolutely fine. But just bear in mind that your strategy might be less scalable in terms of investor capital. So if you're a swing trader trading NASDAQ, your strategy would probably be able to support hundreds of millions under management without having any execution issues. Whereas if you're trading news releases and keeping trades for minutes open, then the impact of slippage and latency and so on is much bigger, and hence you probably could not be managing hundreds of millions with such a strategy. But again, if that is the strategy that works for you, I would recommend you to go for it fully. And then once you realize, okay, hold on, I've reached 10 million and I cannot trade more than that because of scalability issues, then we can sit down and say, okay, how can we improve your strategy?
When we get to that point, we can make adjustments.
Exactly.
When we get $10 million, we can tweak it from that point forward.
Exactly. But there's no point in tweaking anything if we don't know yet whether it will work or not.
At that point, you could probably see on the view screen what the holdup is. Like if the capacity is limited or something, they could tell you that. When you get to that point, they can say, oh, your capacity is one of the 12 metrics is limited, or this or that.
Exactly. That's something we measure. And in fact, that's something we had to do with THA. With THA, they were very aggressive when trading news releases, and they were trading some pairs that were not very scalable because of liquidity. And when they reached the limit, then we talked to them and said, okay, let's have a look at how we can improve that. These are the pairs that we could remove, and these are some other pairs that we could add. So, sorry, Megan is saying news in 3 minutes. That's correct. And also, I wanted to answer one of the questions about options. Unfortunately, we don't offer options. Sorry, that's not something we're going to do. We do offer futures, FX, and stocks and so on, but options is something that we don't offer because of the way our risk engine works. It does only support Delta One assets, and unfortunately, it does not work with options. And then, as a broker, are you not regulated to not recommend a trading strategy, Ignacio? You mean to recommend you, Martin, how to trade, or a trading strategy to invest in? I mean, we are allowed to recommend something, but it's as I said, be neutral about strategies. The thing is, I think there's no one strategy that fits every trader. And my recommendation, as I said, is trade in a way such that you feel confident enough to beat the markets. And as I said, I think beating the markets is hard enough, and adding more complexities in terms of things that you need to adjust to meet our criteria is, in my view, overcomplicating things.
One question, is there something special about keeping within like 6.5% max drawdown, or because the VAR for the S&P is 6.5? Is
Yes.
it good or smart to stay within a certain drawdown limit? Because that goes into your score.
Well, I mean, into our score, we rather measure the risk so the drawdown is, so to say, the outcome of the risk that you're trading with. So my suggestion at Inline, I think it was Martin who was saying that before, my suggestion would be to start with a very low risk, meaning a very low lot size, and see how that translates into how much value at risk that stands for. And then once you have the figure and you know where you stand in terms of risk, you can always adjust the trade sizes. But if I had to choose, I would say start small, and then there will always be room for increase in your risk.
Yeah. So to say you want to keep your VAR within 6.5 or your drawdown within 6.5?
So what we do is we copy all the strategies at a VAR at 6.5, but that does not necessarily mean that you have to trade at that risk level, because if you were trading at 13%, which happens to be twice the risk, that's absolutely fine. We would just copy your trade with half the size, so that we would meet our standard risk level. So you can trade at whatever risk level you like. Okay, of course, the higher the risk, the higher the chances that you will have larger drawdowns and so on. So in that sense, there's no need for you to trade at 6.5 value at risk, because we will be doing that for you anyway. So we will be copying your trades at that risk level anyway. If you feel comfortable with 6.5, go ahead. And in order to adjust or to make sure that you stay within that threshold, my recommendation again is do your thing, trade your own style, and after 2 or 3 weeks, we will be telling you, okay, if you keep trading like that, just so you know, this is the risk at which you're trading. And since that is the risk at which you're trading, and we trade at 6.5, let's say you're trading at 3%, just so you know, you're trading at half the risk that we offer to our investors. So if you were interested in meeting our risk profile, you would need to double the trade sizes, but that's not necessary, because we will be doing it anyway at arm's length. So our risk engine will be copying your trades at that size anyway.
I dig it. So is there any kind of guideline threshold for how to control your drawdown? Just as a rule of thumb?
Keep your risk
low.
under control.
Keep it low. Okay.
Yeah. I mean, I
6.5 sounds like a perfectly fine number, because most places don't let you go beyond 5.
Yes, well, yes, 5 to 10 is I would say, yeah. But again, please note that this does not refer to drawdown, but to value at risk. And in order to know your value at risk, we would need to have a sample of data to tell you, okay, doing what you're doing, you currently stand at 3, 5, 10, 20, or 50, because that's the one thing many traders don't know. I get this a lot with prop firm traders. They tell me, I risk 0.5 per trade. That's my risk strategy. But that's not really a risk management per se, in the sense that, okay, you risk 0.5% per trade, but how many trades do you place a month? If you risk 0.5% per trade and you place 5,000 trades a month, then you're risking a lot. Yeah. Whereas if you're placing 2 trades a month with 0.5% per trade, that's very little risk. So in order to tell you, okay, just so you know, this is how much you're risking on a monthly basis, we would need to have a look at your strategy. So and that's something we can do. Maybe what we can do, David, if that works for you, is my suggestion would be you guys get started, and then when some of you have the Darwin ready and have the strategy listed on our platform and so on, we can maybe do a follow-up call where we analyze the risk and I tell you where you can assess your trading strategy's risk and so on, and then based on that, we can take steps to adjust those trades, that risk if needed, which usually is not needed.
Yeah, we're highly open to that. Like I said, I mean, with our community of traders, there's going to be some traders that are going to be more successful than others. And then naturally they're going to be like, well, what are you doing? You know what I mean? What are you doing to be more successful? Like we've had a few, and it seems to be like going back to taking smaller position sizes, letting the risk engine multiply that seems to be a better success rate than going for larger position sizes and trying to swing for those double digit returns on a daily basis, or swinging for the home runs, basically, just focus on hitting those base hits, if you will, and then letting the risk engine add the multiplier seems to be kind of more of that sweet spot that we've kind of seen with our traders. And we call it the bus route trading, where you're not moving the needle, but you might be moving the needle with Darwin because they're going to add to your risk, but you only make $100 in your account. Well, you probably have made 300 or 400 with Darwin because they're going to add to that, right?
Exactly. So in the specific case of Darwinex, I would not feel comfortable giving you that recommendation, because in the specific case of Darwinex, you would be trading a live account, and then if you're trading with
Right.
very low risk, you would not be making money out of your own money. So in the case of
You're
Darwinex,
not moving the needle, right? Yeah.
you would not be moving. But in the case of Darwin Zero, since we're talking about virtual accounts and it's virtual money, I would definitely recommend you to start with a smaller risk. And although your account is not moving the needle, as you were saying, take into account that our risk engine might be increasing the lot sizes when copying it on behalf of investors. And that could mean, as you were saying, that even though you're making $100 on your account, maybe your Darwin might be making 1,000 and so on. So that's definitely the wisest approach, in my view, in the case of Darwin Zero.
I appreciate that. There are a couple questions here I wanted to get to in chat. Mainly the one that Brendan asked is, how important would you say is the Sharpe ratio? He says, I always secure my trades, but because Darwin's XAU USD is 4 pips less than my copy trading parent, I have to disable sending a take profit and stop loss to Darwin, else my trades will close sooner than expected.
Okay. So, I mean, we do measure the Sharpe ratio. It's not essential for, so the thing with the Sharpe ratio is if you apply it to leverage strategies, it's not as consistent as if you apply it to non-leverage strategies. And since we're talking about leverage systems here, most of the assets we do offer non-leverage stocks and ETFs. But going back to your question, and I know I keep repeating myself, if Sharpe ratio is useful to you and it helps you become a better trader, then by all means, pay attention to the Sharpe ratio. In our case, we do calculate the Sharpe ratio for the Darwins. We do display the Sharpe ratio for all our strategies. And since they all are trading at the same risk level, there the Sharpe ratio makes sense because they are comparable on an apples to apples basis. How relevant is that for Darwinex purposes, for rating and so on? It's not that relevant. If that makes sense.
No, thanks for answering that.
Yeah. I think your D score comes down mostly to just how well your equity curve goes in relation to your drawdown. Simple
that is
as
correct.
That. Yeah.
Yes. Back in the days, we used to, the D score was made out of the combination of the different attributes and so on. But since it's exactly as you said it, Doug. Thank you. Since we are normalizing the risk of all the traders, at the end of the day, we just need to compare their equity curve, because that is what now gives rise to our score. But again, feel free to ignore it. I mean, I'd rather have a trader that makes money and has a bad score than a trader that is focusing on having a fantastic score but does not get consistent return in the market.
Yeah, but if your returns are good and your drawdown is under control, your score will be high.
Yes,
because that's what it is.
Exactly.
Yeah, and the D score controls your ranking and the leaderboards, correct?
Exactly, but
allocation.
The way, but the way I see it is the D score is a consequence of you doing things well, and it shouldn't be your reason. I mean, focus on the trading, and then the D score will follow. But if you focus only on the D score, the results would not necessarily follow. If that makes sense.
It does.
Okay.
Colette, I think I can answer this question, but Ignacio, back me up on this. I don't think it matters. I don't think Darwin Zero cares that we're a group of traders that take similar trades together. Where prop firms care because you look like you're a copy trading. I don't think Darwin Zero really cares that all of a sudden 50, 60 traders have the exact same trading. Is that
So
correct?
there is one thing we measure, which is the correlation between strategies. And the reason being that if we as an asset manager are allocating capital to different strategies, if all of a sudden we allocate capital to the same strategy 60 times, we would be actually increasing our risk or our exposure to that type of strategy. So there is something that we measure, which is correlation across strategies. And in order to measure correlation, we take into account the returns of the different strategies, not necessarily the assets they trade and so on. So we look at 8-hour windows for the last 4 or 5 weeks. Or no, it's actually more. I think it's like, I don't know, a lot of 8-hour windows, and we compare the trade in terms of returns, not of assets or entry time or exit time. So we look at the, okay, so yes, as Brandon, sorry, we do take into account the correlation between strategies in terms of returns, not in terms of assets or trade sizes and so on. So we look at how similarly their equity curves look like, and if they look very similar, although they're trading different assets or maybe they're trading different timeframes and so on, we would be only allocating capital to the best strategy in terms of rating. And if your strategy was ruled out because or excluded of prices because of correlation, we would pay you that month, reimburse you that month's subscription fee because you were ruled out because of that.
Yeah. I gather that if you correlate too much with somebody else, you're not in trouble, but you just have to fix that and do something unique and different, so you're not like a clone of somebody else.
Exactly. We do revisit correlation on a daily basis, though. So correlation is relevant for Darwinia purposes, which are our allocations, but for investor purposes on our platform, that's absolutely fine. So there might be 2 strategies that look very similar, and then investors can choose which one to allocate capital to. So in that sense, yes, we do look at correlation between strategies, but that does not necessarily mean that you are excluded from participating or from getting allocations on our platform.
Okay.
If I can interject a question, if I make a lot of trades, and I do, would it be better then to decrease my amount of trades and increase my sizing a tad?
It's either way, it's fine. Would it be better you mean for risk purposes or?
For risk purposes, because you said if you take a lot of trades, it's more risk.
Well, no. So if you trade a lot of trades, there is more risk than if you take a few trades. That's for sure. But if you trade a very little, only a few trades, but they are of huge size, that might be higher risk. There's 2 things that, well, there's actually 4 factors that matter for risk purposes. But one of them is trading size, and the other one is amount of trade. So if you want to reduce your trades, your risk, you can either reduce your trade size or reduce your amount of trades in keeping the risk constant. So you can play with those factors. But again, if your strategy tells you to trade a lot of times, that's absolutely fine. Do that. I mean, if you feel comfortable with that, that's absolutely fine. No problem. There's no need for you to change anything. Yes, Martin. So basically, and Martin is asking total position size. Yes, it's total position size. And then it's also the duration of your trades is also relevant. So if you're placing trades for 1 minute, those are presumably less risky than a strategy that trades for 10 hours because you're more exposed to the market. And then also the asset you trade is relevant. If you're trading the euro, dollar, or crypto, the risk is different because of the inherent volatility of the asset.
Great. Thanks for answering.
No, you're more than welcome. So
my question is, can one person be a trader, for example, with Trade The Fund, as well as an investor?
Absolutely, yes. The only thing is, please bear in mind that our broker is not regulated. We're not regulated in the US as a broker, and hence we cannot onboard US clients for our broker. And that's one of the reasons why we launched Darwin Zero. It's because it allows us to onboard US clients so they can generate a signal. So if you're based in the US, unfortunately, you would not be able to use our services as an investor or as a trader, just as a Darwin Zero trader. And the same happens with Canada, yes.
Okay. So each investor is exposed to the different trading strategies, and allow
That is correct.
whichever?
That is correct. So investors come to a website and they see all the strategies and they can decide to which of the strategies they want to allocate capital.
Okay. Thank you.
You're welcome. Just one comment. I have a webinar in 17 minutes, starting in 17 minutes. So if you guys would like to join, that's absolutely fine. But I might need to finish within the next 10 minutes so I can jump into that webinar. But I would love to have a follow-up session with you guys because I'm really loving all these questions.
So Nick says, Ignacio, is the overall total position size related to the risk of a monthly measure?
Yes. So to calculate your monthly measure, we look at the amount of trades, the size of your trades, the duration of the trades, and the assets that you're trading. And all these factors taken into account altogether give rise to your monthly risk. And then based on that, if you want to increase or reduce your risk, you can amend these 4 factors. If you amend each of those, all the rest of them keep being constant, you would amend your risk. So
Well, let's be
question.
cognizant of his time, guys. Let's only do like maybe like 3 more questions, and then
Sure,
we'll
go ahead.
wrap up. So go ahead, Diane.
So a question along the lines of what Cliff asked, but except for Darwinex. We have a Trade the Fund member from Uganda, but I understand y'all don't accept traders from Uganda. Is there any way that he can join Darwinex since he's part of Trade the Fund, or is that just a no-go?
So the problem with Uganda or some countries that are excluded from our list is basically we're fine with people from different countries joining us. The problem is we cannot guarantee that we will be able to make payments to these countries because of banking restrictions. So if they can, if they have an account outside Uganda, they can say, okay, I could receive payments in, say, the US because I have a bank account in the US, then that's fine. So the problem is not so much that we don't want them to join our services. The problem is rather that we cannot guarantee that we will be able to make payments to their country.
Yeah, correct.
And hence, so if they, for instance, if they have PayPal, I think they should be able to join our services. So they can maybe send us an email to info@darwinzero.com, and we would be happy to go to their to review their case in detail. But yes, so we have nothing against people in Uganda, and as long as we find a way to make payments to their accounts, we will be happy to have them on board.
Oh, awesome. He does have a US PayPal account. So
Okay, then we should be fine.
thank you.
One question
You're
that keeps
welcome.
popping up with our group is a popular one, is about leverage. And is there any plans in the future to maybe open up that leverage a little bit more than 30-to-1, or what would you say when what's your response when people ask that question? Because I'm sure it's a popular question.
Okay, so here in Europe, leverage is restricted to 1-to-30, and in line with what we were discussing before, especially if we're talking about virtual accounts, in my view, 1-to-30 is fine in the sense that if there's need to increase your risk, our risk engine will be doing that. So just prove that you're good enough with 1-to-30, and then, I mean, as I said, our this trader who's managing 30 million with us or 33 million with us is trading with a leverage, with the same leverage as you guys. So in that sense,
I think and a roundabout answer to that question is trade smaller total position size so that you have all the leverage you need, and then let the risk engine do the rest.
Yeah.
Right?
exactly. Yes.
Yeah.
Yes. The risk engine will, yeah, but with 1-to-30, you can have more than enough returns.
Yep,
Yeah.
exactly.
Saying
In fact,
on the
go
zero
ahead.
side, on
Go
the
ahead.
zero side, it doesn't matter. You just trade small ball, and as long as your ratios are good, it'll multiply you up.
That is correct.
Oh, sorry, Doug, I muted you. I just want to, I want to be cognizant of his time. So, I really appreciate, Ignacio, you coming on. I know you have you have a webinar here, so we don't want to steal your time. But
No worries.
I thank you for jumping on again. Apologize for the miscommunication
No, it
on
was my fault.
time
Sorry for
zones.
that.
My wife says that the world revolves around me, so it's all on
Wives,
my time anyways.
wives are always right. You know that.
But I do appreciate this. I'm sure we would welcome other follow-up calls, and as our community grows into the Darwin and that relationship gets fostered a little bit more, love to have strategy calls and identify and maybe
By
pick
all means.
apart people's trading, all that kind of stuff. Because for me, I really want to be a Darwin educator and know everything that there is to know, so that you don't have to keep jumping on these. I can answer the questions, and then eventually we don't need to have these Q&A sessions. We just have the strategy calls and say, okay, are we in line? Are we doing good? What do we need to tweak? All that kind of stuff, right?
Okay, I mean, if I would be more than honored to join you guys on a regular basis. So if you were saying you have daily sessions, I mean, daily might be overkill, but I can do either weekly or bi-weekly sessions with you guys to answer any questions that may have come up. And I really look forward to seeing you guys at the top of our leaderboard. I know I kept saying this all the time, but just trade safe, trade however you feel more
Trade
comfortable with.
responsibly.
Exactly. Trade responsibly would be my motto, I'd say. Yes. So go ahead, trade responsibly. And that's the best way to make sure that if we speak 1 week from now, things are going well.
And if you guys, the last thing for those of you guys who have sat on the fence, like I said, I'm really diving into making Darwin a focal point for Trade the Fund. And we will, crack the code, so to speak, as we find who's trading better, all that kind of stuff. But if you're on the fence, here's the link for you guys to get signed up. It's only $10 for your first month, and it's like 40 euros thereafter. So it's not that much. And the thing is, you really need a track record. And the last question that I'll ask is just a simple one. And it's something that I thought of, that if you need to make 20% in a year to get to gold, should we align our strategies or our daily goal for that? Should that be our goal with Trade the Fund in the community, is to get people into gold by hitting that 20% annual return? Should that be our goal or our focal point, that's the end result that we want to hit, right?
Yes, I mean, that would be extraordinary. And that's, I mean, we have more than 8,000 members and only 150 made it to gold. So I would say that's pretty ambitious, and that can be your goal, but don't get disappointed if you don't get there. So I mean, making less than 20% a year is absolutely fine. So if we're talking about 10-ish returns a year, that's also fantastic. So don't get disappointed if you don't make it to gold, because it's not easy to make it to gold.
So as a community of traders together, what would you say we should set our sights on, and our target should be on, maybe like a monthly basis? What's a good target? And we can back into that. Does that make sense? Just being green, just being profitable?
I would say so. Yes. Yes.
Okay.
To get started, definitely. Yeah, probably a few percent above the S&P. That would be fantastic.
Okay. Because that's what we typically do, right? If we hit 0.25% a day, that's what we've been doing most days, right?
Yeah. I mean, as long as yeah, that's fantastic. So as long as you don't have a minus 20% month, that's great. And I love that message on the chat that says the 3 C's of Darwin Zero is consistency, consistency, and that's pretty much it. Yes.
Well, thank you. We'll let you go, but thank you, Ignacio.
Thank you so much. And you guys are more than welcome to join our upcoming webinar. And again, I'm really sorry to keep you I kept you guys waiting for so long, and I really look forward to the next session.
And everybody else, we'll do an overnight trade setup tonight at 7:30 my time, because it's my time.
Okay, Chris. Sounds fun.
Thank you.
Enjoy, guys, and looking forward to speaking with you in the future.
All right, thanks,
Take
guys.
care. Cheers.
Thanks a lot.
Thank you very much.
Thank you, Ignacio.